As an entrepreneur preparing to sell your business, you've probably heard of the phrase buyer universe. In this video, we're going to explore what that actually means in the context of a lower middle market and break down the 5 primary types of buyers you might encounter when you go to sell your company. Understanding who these buyers are, what they want, and how they operate will help you approach your sale process with confidence and set you up for a successful outcome. What is the buyer universe? When we talk about the buyer universe, we're referring to the full landscape of potential acquirers interested in businesses like yours. And it's not just private equity. The lower middle market, typically companies with 1 to 15 million of EBITDA, attracts a diverse mix of buyers, all with different investment goals, deal structures, and timelines. The key to a successful transaction is not just finding a buyer, but the right buyer for your business, one that aligns with your vision, values, and desired legacy. Let's walk through who's out there. First is private equity. Let's start with the most well-known group, private equity firms. These are institutional investors who buy and grow businesses with the goal of eventually selling them for a return. They usually look for companies with $2 to $15 million of EBITDA. Deals often involve majority recapitalizations, meaning you might sell 70 to 100% of the business, but keep some equity. They value strong cash flow, scalable models, and a professional team. There are 2 flavors here: platform investors who are buying their first business in a space, and add-on buyers who are acquiring a company to bolt on to an existing portfolio company. If you want to take some chips off the table and partner with experienced operators for the next stage of growth, PE might be a perfect fit. Next up, the strategic acquirer, also known as a corporate buyer. These are companies, often competitors, suppliers, larger players in an adjacent market, who are looking to expand their capabilities or customer base. They typically pursue full buyouts or asset purchases. They're looking for synergies, opportunities to reduce costs or cross-sell services. And they value customer relationships and operational efficiency. Strategic acquirers can offer strong valuations and fast execution, but the flip side is they may bring cultural integration challenges, or they might want to absorb your team into their structure. Next, we have the independent sponsor. Another group you'll come across is an independent sponsor, sometimes called a fundless sponsor. These are experienced individuals or small teams, often former executives or private equity pros, who find the deal first and then they raise capital on a deal-by-deal basis. They often propose majority buyouts with rollovers or earnouts. They're hands-on, operators who bring energy and strategy to the table. But because they don't have committed capital up front, there can be some deal certainty risk. If you're looking for a more personal and entrepreneurial approach, and you're comfortable with a slightly longer process, this can be a solid path. Next, we have family offices. Let's talk about family offices. These are investment firms that manage the wealth of high net worth families, and they often take longer term, legacy-minded approaches to investing. They're discreet, flexible, and patient with their capital. They offer majority or minority investments, often with custom deal terms. They value cultural fit, sustainability, and stable cash flows. For sellers who care deeply about their company's long-term future and reputation, family offices can be ideal partners. Last but not least, we have search funds, or entrepreneurship through acquisition, buyers. These are usually younger operators, sometimes recent MBAs, who are backed by investors to find and run businesses themselves. They typically target businesses with 1 to 5 million of EBITDA. Deal structures are typically full buyouts, but often include transition support from the seller. They value clean operations, loyal teams, and seller mentorship. If you're looking to step away gradually and mentor a first-time CEO, this might be a great path for you. So there you have it, 5 distinct buyer types in the lower middle market: private equity firms, strategic acquirers, independent sponsors, family offices, and search funds. Each brings something different to the table. The right buyer for you depends on your goals, whether that's maximizing value, preserving your legacy, or finding a partner to help scale the business. At DealGen Partners, we help founders like you navigate the universe with clarity and confidence so you can choose the right path and close with peace of mind. If you're exploring a sale or just want to better understand your options, let's talk. We're here to help you make an informed, successful exit.